I want you to take a second and just look around at the financial landscape of early 2025. If you're just a casual observer, it looks like a new golden age, doesn't it? The S&P 500 is defying gravity. The Nasdaq is printing massive green candles week after week. The story everyone is telling right now is seductive and simple. Artificial intelligence is the new electricity, and we are just in the first inning of a revolution that's going to rewrite the laws of productivity forever. You can see the euphoria in the valuations. NVIDIA isn't just a hardware company anymore. It's basically acting like a sovereign state in the global markets. Microsoft is trading at multiples that suggest it has somehow conquered death itself. Venture capital firms are pouring sovereign wealth fund levels of cash into startups that didn't even exist 18 months ago, handing them valuations that rival established airlines or car manufacturers. It feels unstoppable. It feels euphoric. It feels inevitable. But I want you to look closer. If you strip away the flashy press releases and the glossy keynote presentations, and you look at the raw flow of capital, the actual plumbing of the financial system, you start to see a pattern. And if you've studied financial history, this pattern is terrifyingly recognizable. I'm not talking about a simple market correction here. I'm talking about a specific mechanism that I watched vaporize trillions of dollars of wealth during the fiber optic bust of the late 90s and the collapse of the telecom giants in 2001. The difference this time? The trap is much more sophisticated. The capital fueling this rally isn't just flowing into AI infrastructure. It is looping. It's a closed system where the investment dollar leaves a big tech balance sheet, travels through a shell company or a strategic partner, and then boomerangs right back to the original company as revenue. It is a financial Ouroboros, a snake devouring its own tail to keep itself alive. And the thermodynamics of this system are starting to break down. Let me walk you through exactly how this illusion works. Imagine a hyperscaler. Let's use a theoretical composite of the market leaders. They invest heavily in a hot new AI lab. But that lab doesn't use the cash to build a factory or hire a sales team. No, they are contractually obligated to hand that cash right back to the investor to rent cloud compute. The investor then books this as cloud growth. The stock algorithms read growth, they buy, and the price goes up. But ask yourself, was any net new wealth created? No, the money just went on a round trip. In the world of forensic accounting, this trick has a lineage. In the 1990s, we saw this with companies like Global Crossing and Quest. We saw it with Enron's Raptor vehicles. Today, we are witnessing round-tripping 2.0, but the scale is orders of magnitude larger. We aren't dealing in millions anymore. We are dealing in a GDP-sized loop of vendor financing. Think about the specifics. When the dominant GPU manufacturer helps finance a specialized cloud provider, and that cloud provider uses the funds to buy GPUs from that manufacturer, and then uses those GPUs as collateral to borrow more money to buy more GPUs. That is not organic demand. That is synthesized demand. By the end of this deep dive, you're going to understand the three pillars of this house of cards: the circular financing loops, the accounting sleight of hand regarding depreciation, and the hard physical wall of energy physics that no amount of capital can bypass. This is the story of the greatest wealth transfer of the decade. Let's dissect the machine, the scale, the ecosystem of leverage. To really understand the blast radius of what is forming, we have to look at the sheer concentration of risk. In previous technological cycles, risk was distributed across hundreds of players. In the 2000s, it is centralized in a way that creates a single point of failure for the global economy. In 2024 and 2025, the capital expenditure, Capex, of just 4 companies has eclipsed the GDP of entire mid-sized nations. They are spending upwards of $200 billion annually, primarily on one thing: the NVIDIA H100 and the new Blackwell architecture. But here is where the vendor financing trap creates a false signal. In a normal, healthy market, if a company sells a product, it's because a customer used revenue from their own operations to buy it. In the current AI economy, the customer is often just a reflection in the mirror. Look at the structure of the deals. Amazon committed a staggering $4 billion to Anthropic. Google followed suit with billions more. Microsoft has effectively absorbed the operational capacity of OpenAI, with investments exceeding $13 billion. On the surface, these look like venture bets, but dig into the terms. These aren't cash handouts for general corporate purposes. These are cloud credit schemes. The billions invested are earmarked credits that must be spent on AWS, Google Cloud, or Azure. So, when Anthropic spends $4 billion on AWS, Amazon records that as high-margin revenue for its cloud division. Wall Street cheers the cloud growth. But Amazon gave them the money to spend. It is moving money from the left pocket, investment, to the right pocket, revenue, and the market is applying a 30 times multiple to the money in the right pocket. This creates a hall of mirrors effect. The most egregious examples are happening in the neo-cloud sector. Take the relationship between the chip manufacturers and the specialized GPU cloud providers. Reports indicate that xAI is structuring a vehicle to acquire billions in hardware, with the hardware manufacturer itself effectively injecting equity or financing into the deal. This is the textbook definition of stuffing the channel. If I lend you money to buy my lemonade, have I actually sold any lemonade? Or have I just taken on credit risk and disguised it as sales growth? Venture capitalist David Sachs and other Silicon Valley insiders have started referring to this as a subsidy cascade. The revenue quality of the entire AI sector is suspect because a massive percentage of it is internal to the venture-backed ecosystem. It is not Ford or Coca-Cola buying AI to improve earnings. It is AI startups buying compute from big tech, financed by big tech and VC funds, to build models to sell back to whom? Major financial institutions, including the risk desks at JP Morgan, are beginning to red flag these loans. They realize that the revenue supporting these debt repayments is recursive. If the funding tap turns off, the revenue stops, the collateral crashes in value, and the loan becomes a toxic asset. This is subprime mortgage logic applied to silicon wafers. The cash incinerator, unit economics from hell. This brings us to the second pillar of the thesis, the burn rate. If the revenue is largely circular, what about the profitability? Are these companies actually keeping any money? The unspoken reality of generative AI in 2025 is that it is the most capital-intensive business model ever invented. We are seeing cash burn rates that defy the logic of software economics. Usually, software is a high-margin business. You write the code once, and selling it to the millionth customer costs almost nothing. AI flips this logic on its head. Every query, every generated image, every summarized email costs a significant amount of electricity and compute. The marginal cost is not zero. It is punishingly high. Let's look at the operational reality of the market leader, OpenAI. While their private financial details are guarded like state secrets, leaks suggest a burn rate that is catastrophic. Projections place their losses in the range of $5 billion to $10 billion annually. Why is the hole so deep? It's what I call the tax of the stack. To run ChatGPT, OpenAI is paying a markup to NVIDIA for the chips, then a markup to Microsoft for the energy, cooling, and rack space. They are paying rent to multiple landlords just to keep the lights on. Contrast this with the Google architecture. This is a crucial distinction the market is missing. Google has spent a decade building its own silicon. They do not pay the NVIDIA tax. According to deep dive reports, Google's total cost of ownership is roughly 30% to 50% lower than competitors relying on the NVIDIA Azure/AWS stack. This is a structural moat. As we move into late 2025, we are seeing the cracks in the first mover advantage. Traffic to ChatGPT has shown signs of plateauing. Meanwhile, the cost to train the next frontier model is estimated to be in the billions. If you are losing $3 on every customer query, you cannot make it up in volume. The market is starting to price in this execution risk. Look at the debt markets for the GPU cloud providers. The bond market is smarter than the equity market. Equity investors see AI future. Bond investors see, can you make the interest payment if GPU rental prices drop by 20%? And that is the terrifying part. GPU rental prices are dropping. We are seeing a race to the bottom in inference costs, which destroys the margins of the companies carrying billions in debt to buy these chips. Innovation in accounting, the depreciation arbitrage. Now we arrive at the most technical, yet perhaps the most scandalous part of this story. How are big tech companies showing growing profits while spending $50 billion a year on hardware that becomes obsolete in 18 months? The answer lies in a boring line item on the income statement: depreciation. Depreciation is the accountant's estimate of how long an asset lasts. Think of it like a car. If you buy a server for $10,000 and say it lasts 5 years, you take a $2,000 expense each year. If you say it lasts 10 years, you only take a $1,000 expense. Instantly, you have created $1,000 in profit just by changing a number in a spreadsheet. Historically, servers were depreciated over 3 years. Silicon wears out, and more importantly, it gets outdated. Moore's law dictates that a 4-year-old server is essentially junk. However, starting around 2020, the hyperscalers quietly extended the useful life of their servers, first to 4 years, then to 5, and in some cases to 6 years. This accounting gimmick added billions of dollars to their bottom lines. It artificially inflated their EPS, which in turn inflated their stock prices. But in 2025, the reality of AI hardware forced a reckoning. Amazon stunned analysts by reversing course. They finally acknowledged that AI servers, the ones packed with GPUs, burn out faster and become economically obsolete quicker. They shortened the useful life back to 5 years for certain assets. This admission cost them hundreds of millions in quarterly profit on paper. But here is the smoking gun. The other hyperscalers have not all fully capitulated to this reality yet. They are still holding billions of dollars of GPUs on their books, assuming these chips will be valuable assets in 2030. Ask any engineer, will an H100 chip be a valuable asset in 2030? Of course not. It will be e-waste. The secondary market confirms this. In 2023, you couldn't rent an H100 for love or money. Spot prices were $8 per hour. By late 2025, spot prices have collapsed to under $2.50 per hour. Supply has flooded the market. This creates a phantom earnings problem. Analysts like Michael Burry have pointed out that if you applied a realistic depreciation schedule to the AI clusters, the record profits of big tech would evaporate. They are capitalizing costs that should be expensed. They are pulling forward future earnings to justify today's stock price. We are looking at a depreciation wall of roughly $150 billion to $200 billion across the sector. When the auditors finally force the companies to write down the value of these billions of obsolete chips, the hit to equity will be massive. The Capex cliff, the $2 trillion problem. Let's zoom out to the macro level. The math of the AI build-out has totally detached from economic reality. In 2025, the combined Capex of the tech giants is trending toward $500 billion. To justify this, you need to generate $1 trillion to $2 trillion in incremental revenue eventually. Where is that revenue coming from? Right now, consumers pay $20 a month for chatbots. Enterprises are paying for co-pilots. But the total addressable market is currently in the tens of billions, not trillions. There is a $1.5 trillion gap between what is being spent on infrastructure and what is being earned from software. This gap is currently being filled by private credit. Because traditional banks are wary of lending against volatile assets like GPUs, the shadow banking sector has stepped in. They are lending money to the startups to buy the chips, using the chips themselves as collateral. This is exactly what happened in the 2008 housing crisis. We thought housing prices only went up, so lending against a house was safe. Today, the market assumes GPU utility only goes up. But if the spot price of compute falls, the collateral value collapses. If a cloud provider defaults on its $5 billion loan, the lender repossesses 50,000 H100 chips. But who do they sell them to? The market is already flooded. The value of the collateral is correlated to the health of the borrower. This is wrong-way risk 101. The hard ceiling. Thermodynamics versus economics. Even if the money was infinite, the physics are not. There is a hard stop approaching that no amount of financial engineering can bypass: the power grid. We are entering a crisis of electrons. A modern gigawatt-scale data center consumes as much power as a major city. We are talking about singular buildings that require the energy output of a nuclear reactor. The United States power grid is creaking. Transformer lead times are stretching to 3 or 4 years. You can write a check for $1 billion in an afternoon. You cannot build a high-voltage transmission line in less than 5 years. The regulatory red tape, the NIMBY lawsuits, and the physical manufacturing constraints create a bottleneck. Research indicates that the density of data centers is pushing grid stability to the limit. We are seeing proposals that would raise electricity prices for residential consumers by 20 to 30% to subsidize the transmission lines needed for big tech. This creates a deployment wall. Companies are buying chips that they physically cannot plug in. We have reports of zombie clusters, Warehouses full of GPUs sitting in boxes because the local utility cannot grant the power connection permit for another 18 months. Depreciating assets sitting in a box. That is the ultimate capital destruction. The signal. The smart money is leaving. Finally, the most damning piece of evidence isn't in the spreadsheets, it's in the behavior of the people who built the spreadsheets. Watch the hands, not the mouth. While CEOs go on CNBC and talk about the new industrial revolution, look at their personal stock portfolios. In late 2025, we are seeing historic levels of insider selling. Peter Thiel's Founders Fund reportedly exited its NVIDIA position entirely. This is a man who understands exponential curves better than almost anyone. If the AI supercycle was truly just beginning, why sell the shovel maker? Jeff Bezos has liquidated billions in Amazon stock. Mark Zuckerberg has been selling Meta shares at a record clip. The narrative is estate planning or philanthropy. The reality is asset rotation. They are selling high beta tech equity and buying tangible assets, land, bonds, bunkers. Even within the AI industry, the tone is shifting. Demis Hassabis has issued public warnings about the hype cycle. When the scientists are telling you the salesmen are lying, you should listen to the scientists. SoftBank is seeing extreme volatility. They post massive paper gains, but the market discounts their stock because it knows those gains are illiquid. You can't pay debts with paper markups of a private AI startup. Conclusion: the anatomy of the crash. So, how does the movie end? History provides the script. We are looking at a replay of the year 2000, but with higher stakes. In 2000, the internet was the future. That wasn't a lie. But the infrastructure built to support it was built too fast, too soon, using too much debt. Cisco Systems was the NVIDIA of 2000. It briefly became the most valuable company in the world. It fell 80% when the circular financing of the telecom sector unraveled. The internet survived. The investors in the infrastructure did not. The AI crash will likely follow the Cisco contraction. The startups will run out of cash and stop buying chips. The revenue miss. Hyperscalers will report a sudden sequential decline in cloud growth. The collateral call. Private credit lenders will seize hardware that is worth 30 cents on the dollar, triggering a credit freeze. The write-down. Auditors will force big tech to acknowledge that their 6-year depreciation schedules are fiction. Billions in earnings will vanish overnight. This isn't doomerism. It is a cyclical inevitability. The gap between Capex and revenue must close. Currently, it is widening. If you are an investor, this is the most dangerous time to be long the narrative. The smart money is looking for the exits or hedging their exposure. Here is your playbook. First, ignore the P/E ratios based on forward earnings. Those earnings are constructed on the shaky foundation of circular spend. Second, watch the inventory and accounts receivable lines of the hardware makers. If inventory rises, the party is over. Third, and most importantly, understand that real wealth is made by buying after the leverage unwinds, not by chasing the top of a momentum trade powered by vendor financing. The bubble is the mechanism the market uses to subsidize the future. The future will be amazing. But the bill for the bubble is coming due, and you do not want to be the one holding it. If you want to navigate the collapse of the paper AI economy and find the real value that will emerge from the ashes, make sure you are subscribed. We are going to track every cracked foundation in this house of cards. I'll see you in the next one.